For a lot of beginners, looking at the stock market feels exactly like walking into a casino. You see people obsessing over short-term trends, drawing lines on charts, and trying to guess if a stock is going to bounce up or crash down in the next 10 minutes. But this chart reveals the harsh reality of that strategy. According to the Motley Fool, more than 95% of day traders lose money rather than making it. Trying to outsmart the daily chaos is a reliable way to drain your bank account. To actually build wealth, you have to abandon the mindset of looking for a quick fling. You need to approach the market like a matchmaker, searching for a serious, long-term relationship. Buying a share makes you a part owner of the company, creating a direct partnership between you and the business. Before we get into how to pick those businesses, remember, investing carries risk. The value of your capital can fluctuate, and your money can go down as well as up. Always invest responsibly. Instead of guessing based on unpredictable chart patterns, we are going to use fundamental analysis. This means acting like a detective and thoroughly investigating a company's financial health before committing a single dollar. True wealth requires treating your stock purchases as serious commitments to reliable partners, rather than reacting to the daily noise of the market. The first place to look is the balance sheet. Think of this as checking a company's dating profile to see if they are actually financially stable or if they are hiding a massive pile of debt. This simple calculation identifies their short-term financial risk. By dividing a company's total current assets by their total current liabilities, we get a ratio. To ensure they can actually cover their debts over the next 12 months, this number must be above 1. Next, we run a background check on their past performance using the income statement. This equation shows us their profit margin by dividing operating income by total revenue, giving us a clear percentage of how much money they keep after their expenses. When evaluating established companies, you want to see a healthy margin landing between 10 and 20%. Anything lower might indicate they are struggling to keep their costs under control. Finally, we check their day-to-day money habits using the cash flow statement. This tracks the cash coming in and going out of the business operations. A major red flag here is finding a company that pays out high dividends to investors while operating with a negative cash flow. That is exactly like someone without a job continuously buying expensive gifts for their friends on a credit card. It will eventually collapse. On the other hand, look at Coca-Cola. In 2023, they gave away nearly $8 billion in dividends. But because their cash flow statement reveals massive, sustainable daily profits, they can easily afford it. A company might look great on the surface, but if its financial profile reveals crushing debt or unsustainable cash habits, it will drain your wealth. But numbers on a spreadsheet don't capture everything. They can't measure customer loyalty or how recognizable a brand is. For that, we need qualitative analysis. We look for a competitive advantage, a protective moat around the business. Tesla, for instance, built a massive proprietary charging network. That infrastructure makes it incredibly difficult for rivals to catch up, lowering the risk for investors. We also have to evaluate executive leadership, the length of time a CEO has been in charge, and how predictably they behave in public directly impacts the safety of your investment. A single erratic public statement can cause immediate damage. In 2016, Donald Trump sent out a single tweet criticizing the cost of the military contract. Because that contract was for Lockheed Martin's F-35 program, the company's shares fell by 2.5% that very same day, wiping out nearly $4 billion in market value. Perfect financial metrics provide zero protection against an erratic CEO or a weak brand presence. Qualitative research is your necessary shield against these unpredictable risks. Even when you find a company that passes all these checks, you shouldn't put all your money into it. A stable portfolio requires exploring different categories of stocks. Value stocks belong to large, well-known companies that provide everyday necessities like toothpaste, food, and energy. Because people need these items regardless of how the economy is doing, these stocks tend to be stable and frequently pay out dividends. Growth stocks operate differently. Often led by visionary tech founders, these companies are highly volatile. They rarely pay out dividends because they rapidly reinvest their profits back into the business to fuel future expansion. To balance these types, we rely on the strict rules of diversification. This diagram outlines the limits. Put no more than 5% of your money into one single stock and no more than 20% into a single sector, like technology. Aim for a minimum of 25 different stocks spanning multiple sectors and countries. Diversification mathematically prevents a single corporate failure from wiping out your entire net worth. If one company struggles, the others keep you afloat. Every investment experiences rough patches. The financial media thrives on fear-mongering, and those alarming headlines often trigger temporary market panics. We see this exact behavior in the real world. When rumors about supply shortages hit the news, people panic buy household items, emptying the shelves and actually creating the shortage they feared. Stock investors do the exact same thing, selling off perfectly good shares in a panic based on a single news cycle. Fundamental investors hold strong through these dips. Because they put in the time to verify the balance sheets and the competitive advantages, they trust their research over the daily noise. There are 3 strict reasons you should ever sell a stock. 1. A personal financial emergency where you need cash. 2. The stock hit a specific life goal and you want to enjoy the gains. Or 3. The company's underlying fundamentals are permanently broken. If you vet your investments thoroughly, ignore the frantic media noise, and hold on to your shares for the long haul, you build genuine wealth. If you found this breakdown helpful, hit the like button, subscribe to the channel, and let me know in the comments which company you are researching right now.